Hello there. Welcome to part 2 or the second session in this course on financial accounting. In this session, we'll cover the entire accounting cycle. We'll start by learning how to make journal entries, and then I'll take you through the entire process on making financial statements, and eventually we'll look at the closing process where we reset for the next time period. Okay. In this session, we're going to start by looking at the various assumptions and principles that guide financial accounting. Okay, we'll look at the foundation or the framework on which financial accounting is based on. Okay, next we will revisit the various financial statements we looked at in part 1. Okay, we'll look at them in a bit more detail so it becomes easier to understand the entire accounting cycle. Okay, then we'll move on to the meat of the session, which is guiding you through the accounting cycle. We'll use an example to understand the different steps in the accounting cycle. Okay, just the second step, making adjustments, will be covered in a bit more detail in the next session. Okay, we are not going to be looking at that in this particular session because I feel like it requires its own session. Okay, because there are so many different types of adjustments, and to have its own session makes more sense. Okay, let's get started with the assumptions and principles that form the framework for financial accounting. Be informed that this list is not exhaustive in any way. Okay, I've tried to put together the most important assumptions and principles, but this is just a list that has been put together for you to have a better understanding of financial accounting. Okay, we'll start first with the economic entity assumption. The financial statements of a company represent the activities of that company only. Okay, the statements do not represent the activities of the owner or his own personal financial transactions, right? Okay, they have to represent the activities of the company only. Next, we move on to the going concern assumption. What does that mean? The company will continue to operate for the foreseeable future. We assume that the company is not going to go bankrupt in the next few years, right? So we're going to assume that they will continue to operate in the near future. Next, the monetary unit assumption states that all financial transactions should be recorded in the same currency. Okay, when you have them all in the same currency, it's easier to put everything together and it's easy to understand, right? So if it's an American company, of course you expect them to report all the numbers in US dollars. Finally, the time period assumption states that financial statements should be prepared for a specific period of time, like a month or a quarter or a fiscal year, right? Depending on your reporting period. Okay, then we'll look at some of the key principles that guide financial accounting. Okay, first we start with the historical cost principle. Assets should be recorded at their original cost, and that this cost should not be adjusted for inflation or other factors, right? Okay, assets have to be recorded in the cost in which they were acquired, right? That's what I mean by historical cost, right? And this cost should not be adjusted in any way. The revenue recognition principle states that revenue should be recognized when it is earned, not when it is received in the form of cash. Because cash could be paid in advance or cash could be paid later, it doesn't matter. Revenue should be recognized when it's being earned. To go along with the revenue recognition principle, we have the expenses matching principle, okay, which states that expenses should be matched with the revenue they generate, because expenses should be recognized in the same period as the revenue they help generate. Next, as per the full disclosure principle, all relevant information about a company's financial performance should be disclosed in its financial statements. So according to this principle, companies cannot hide very specific sensitive information that can be useful for investors, right? Full disclosure is key. Finally, we move on to conservatism principle. According to this principle, accountants should err on the side of caution when making estimates. When you make estimates, you have to be conservative. So when you estimate assets or revenues, you have to make sure that you don't overstate them in any way. Before we look at financial statements in detail, I would like to introduce to you what accrual accounting is. More precisely, we'd be looking at the differences between cash-based accounting and what accrual-based accounting is. In accounting that is cash-based, we record all kinds of revenues and expenses whenever cash is received or paid. But under accrual accounting, we record revenues and expenses whenever they are incurred, regardless of when cash is paid or received. We saw a few moments ago the revenue recognition principle, right? So accrual accounting is based on that particular principle, okay? Revenue and expenses are recorded whenever they are incurred. Obviously, cash accounting is simpler to understand and use because whenever cash is received or paid, a transaction is being recorded. But accrual accounting is a bit more complex, right? It requires sophisticated procedures to define when revenues or expenses are going to be recorded. Okay, cash-based accounting is often used by small businesses, right? If you're a small business, typically all your transactions are settled in cash immediately, right? If a customer buys a product or a service from your business, typically it's going to be settled in cash immediately, right? On the other hand, accrual accounting is often used by large businesses, right? Why might that be the case? Because cash accounting may not provide a clear financial picture, right? You might end up reporting profits when you're actually losing money, for example, right? So accrual accounting takes that into consideration. If you really think about it, in the long run, there shouldn't be any differences between whichever method you choose, right? But in the short run, accrual accounting really helps to provide you a clear picture of your financial health and performance and doesn't provide any misleading numbers to investors, okay? Okay, now we'll look at the different financial statements in a bit more detail, okay? We'll start with the balance sheet. We've already been introduced to the balance sheet equation in session 1, okay? We saw that the sum of your assets should be equal to the sum of your liabilities and stockholders' equity. Assets are all the resources a firm owns, like cash, inventory, machines, all these can be classified as assets. On the other side of the equation, liabilities and stockholders' equity are everything a firm owes to its creditors or its owners, right? Okay. Under liabilities, you find everything the firm owes to its creditors or suppliers, for example. Under stockholders' equity, you find everything that a firm owes its owners, right? Or stockholders if you're talking about a big public company, right? Okay. Okay, why do we expect this equation to always stay in balance? If you think about it, how does a firm initially raise funds? Either they can borrow some money from their creditors or the owners themselves can invest their own funds into the company, right? Okay. This initial capital can be used to buy assets for the firm. So it's easier to follow why the balance sheet equation stays in balance at the beginning, but as a company goes through its operations every year and starts generating a profit, this profit is eventually owed back to the owners. Okay, so whatever profit that is raised, which is in the form of cash, is owed back to the owners eventually, right? So this equation gets bigger on both sides as a firm becomes more profitable and starts growing more and more. Okay, but it always stays in balance. It can be harder to visualize why it always stays in balance, but don't worry. I will take you through an example and you will see that how at every step of transactions, the balance sheet always stays in balance. Okay. We'll look at some of the most common accounts that fall under assets, liabilities, or stockholders' equity, right? Remember, a balance sheet shows the balances of all these accounts at any point in time. It's similar to the bank balance in your own personal bank account, right? Okay. For example, cash shows you how much cash the firm has at the end of the reporting period. Okay, how do we identify which accounts are typically classified under assets? Assets are entities that are valuable right now or that can bring some kind of future benefit, right? So for example, accounts receivable is something that brings you a future benefit, right? Okay, you don't have that cash right now, but your customers are going to pay you later. Okay, so that's an asset. Inventory is an asset because you can sell it and convert into cash at some point, right? Prepaid expenses, for example, are an asset because you paid for an expense in advance and you would benefit from that in the near future. So for example, if you paid for insurance in advance, you benefit from using that insurance in the future. Okay. Any long-term investments or plant, property, and equipment are classified as assets because they can help you generate cash in the long run. Assets can also be intangibles, for example, patents, which can also help you generate cash in the long run. On the other side, liabilities are everything that you owe your creditors, right? For example, accounts payable. If you bought something from your suppliers and you haven't paid them yet, then that's classified as an accounts payable. That's a liability because you owe your suppliers in the near future. You're liable to pay to them in the near future. Okay. Accrued expenses are a liability because you've incurred certain expenses but you haven't paid for them yet. Okay. Unearned revenue is a liability because your revenue has not been earned yet. Okay. Your customer has paid you cash in advance, But in order to earn the revenue, you have to provide them with the service or product you promised to deliver, right? Until then, this revenue is unearned and hence it's a liability. It's a liability because for some reason, if you're unable to deliver this product or provide the service in the future, you might have to return the money that has been paid by your customer in advance. Finally, under stockholders' equity, you find everything that has been invested by your owners or shareholders, okay? And under retained earnings, you will find all the profit that has been generated and retained by the firm. Earnings is just another word to specify profits, right? Okay. So profits that have been retained by the firm, you will see under stockholders' equity. Because eventually stockholders' equity is everything that the firm owes its owners, right? So it's just a way of showing that the profit that has been retained by the firm is owed to the owners eventually. Okay, so what does a typical balance sheet look like? So let's say the fiscal year for a firm ends on December 31. A typical firm would report its assets in the order of its liquidity. Okay, for example, it would report its current assets first and then its non-current assets. Under current assets, you would find cash and every other asset that can be converted to cash within a 12-month period. Okay, for example, accounts receivable or inventory, all these are classified as current assets because they can be converted into cash in the near future. Under non-current assets, you would find any kind of machinery, for example, right? You bought those machines with the intention of producing something and generating cash in the long run, right? And hence they are classified under non-current assets. Under liabilities too, we find current liabilities and non-current liabilities, right? Okay. Current liabilities are liabilities that mature within a 12-month period. For example, what you owe your suppliers in the form of accounts payable would be classified under current liabilities, okay? But if you have a long-term bank loan, okay, what you owe in the next 12 months would fall under current liabilities. Everything else would fall under non-current liabilities. We'll look at each section of the balance sheet in a lot more detail in the forthcoming sessions, right? So you don't really have to make an effort to memorize which accounts go under assets, which accounts go under liabilities, because as you follow the rest of this course, you see that these account names are repeated over and over and over again. And eventually you reach a point where you just know where each of these accounts belong to, okay? So there's really no incentive in trying to memorize these account names and trying to classify them, okay? Finally, you find stockholders' equity and the total of liabilities and stockholders' equity in the balance sheet, okay? And that total should match the total assets, okay? Because of the balance sheet equation. Next, we'll look at the income statement. A typical income statement lists all the revenues and all the expenses and eventually shows the calculations that lead up to the net profit generated by the firm. Then the statement of retained earnings takes the net income from the income statement, adds it to the beginning retained earnings for that time period, subtracts whatever dividends that have been paid, and calculates what's the retained earnings at the end of that time period. Okay, this retained earnings at the end of the time period is reported in the balance sheet. Okay, under stockholders' equity, you would show retained earnings being reported. So ideally, you would want to do the income statement first, then the statement of retained earnings, and then follow it up with a balance sheet. Eventually, you'd also want to create the statement of cash flows. This statement classifies the cash transactions into three categories, okay? Under operating activities, under investing activities, and cash flows under financing activities. And then putting it all together with the balance they had at the beginning of the year, you can also calculate the cash that is left at the end of the year. Okay, this is also reported in the balance sheet under assets. Okay, this is how all the four financial statements somehow work together. Okay, now that we've laid all the groundwork, we can move on to what you came here for, to learn about the accounting cycle. In the rest of the session, I will take you through how to prepare journal entries, how to prepare your trial balance, how to prepare your financial statements, and then we'll conclude with the closing process, which helps you to reset for the next time period. Okay, just the second step, how to make adjustments at the end of each closing period, will be covered in the following session, which is session 3. Okay, let's get started with the first step on how to make journal entries. Okay, I will introduce you here to the double entry bookkeeping system of debit and credit. Okay, you'll have to put aside your real world understanding of what debit and credit means and just try to understand what I'm going to take you through right now. Okay, You can show journal entries in several ways. One of those ways is using a T account. Okay, you would write the name of the account on the top of the T, and if the account has to be debited, you would use the left hand side of the T to specify that, or if that particular account should be credited, you would specify that on the right hand side. Okay, so now we move on to the $1 million question for a beginner, right? How do we know which account to credit and which account to debit? Okay, a simple rule of thumb for a beginner to follow is to understand that a benefit is being provided from one account to the other. Okay, if you identify the source of this benefit, you would credit that account. And if you identify the destination of this benefit, you would debit that account. Okay, let me take you through that using an example. Okay, let's say you're spending some cash to buy some supplies. Okay, the cash you spend is the source of this benefit, right? So the cash account should be credited. Okay, on the other side, the supplies or the inventory account, which is the destination of this benefit, okay, that account would be debited. Okay, so if you're a beginner, this simple rule helps you not make mistakes in very simple transactions, right? You will see that this makes a lot of sense in several simple transactions. Okay, but as you make more and more journal entries and you move on to more complex transactions, you will move to a larger framework that helps you identify which accounts should be debited or credited. This framework shown here should help you make journal entries for almost any type of transaction. Okay, so we saw in the previous slide that if you spend some cash to buy some supplies, the cash account is going to be credited and the supplies or inventory account is going to be debited. Okay, you can see that cash and inventory are both assets. Okay, when the cash account is being credited or when the cash goes down, okay, your inventory goes up or your inventory account is being debited. Because both these accounts are assets, you can simplify it in a format to say that for any asset, if it goes up, you have to debit that account. Or if an asset goes down, you would have to credit that account. We'll keep this as a starting point and we move on to the other side of the equation. Okay, for liabilities, you're going to flip what you learned about assets. Okay, if a liability goes down, you would debit that account, or if a liability goes up, you would credit that account. Okay, for example, if your accounts payable, which is a liability, if it increases, it means you should credit that account. Staying on with what you learned about liabilities, you would follow the same for stockholders' equity. Okay, so for any type of stockholders' equity, okay, if the account has to go down, you would debit that account, or if the account goes up, you would credit that account. Under stockholders' equity, it is important to include revenues and expenses as part of the framework because you will go through a lot of journal entries that fall under the category of revenues or expenses, right? Deducting expenses from revenue eventually gives you your net income, and after deducting dividends from that, you would end up with your retained earnings. Okay, so the higher the revenue, the more retained earnings would be reported under stockholders' equity. And hence, revenues follow the same sign of debit and credit as stockholders' equity. Okay, so when your revenue goes down, or if there is a revenue reversal, you would debit that account. Okay, or if your revenue goes up, you would credit that account. Okay, because expenses are inversely proportional to retained earnings. What do I mean by that? When expenses go up, retained earnings go down. So if you'd like to record an expense, you would have to debit it, okay? Or if you would like to reverse an expense for whatever reason, you would have to credit that account. So if you're somewhere in the beginner to intermediate stage on your financial accounting understanding journey, okay, then this framework can be considered a good starting point in helping you make these journal entries. Okay, now let's look at how to actually show these journal entries, right? Okay, we already saw how a T account works, okay? You write the name of the account at the top, and if you're going to debit that account, you would write that on the left-hand side, or if you're going to credit that account, you would write that or show that on the right-hand side, okay? You can also show journal entries in the following manner, okay? You can first show the accounts that have to be debited and follow that by the accounts that have to be credited, okay? But when you show the accounts that are to be credited, you should indent those account names a bit so it's obvious that those accounts have been credited. Okay? This practice also helps you verify if the sum of the debits is equal to the sum of the credits. Okay? The reason I specify here accounts in the plural form is because you will see later that maybe there are cases that more than one accounts are debited or credited. Okay? So it doesn't have to always be one account that is debited and one account that is credited. So enough talk about how to do debits and credits. We're going to dive into actually doing them using an example. Okay. I'm using a fictitious example here where I take you through the setup of a company, okay, and all the transactions in a single month, okay. And in the closing process, we will see how the temporary accounts are being reset at the end of the month of January so that they can be used for February, for example, okay. Okay, let's look at transaction A. On the 1st of January, Joe, who is the founder of the business, okay, Joe invests $5,000 of his own funds to set up a retail business. So Joe is investing 5,000 of his own funds, right? Okay. So stockholders' equity should obviously go up by 5,000, and the business now is in possession of $5,000 of cash. Okay. So cash should also go up by $5,000. Okay. So if you go back to the framework, cash goes under assets. Okay. So the cash account should be debited by $5,000, and stockholders' equity, okay, should be credited $5,000. Okay. So cash, which is an asset, will be debited by $5,000. Okay. And under stockholders' equity, we're going to call the account contributed capital to denote the capital that has been contributed by the owner, right? Joe is the owner who is investing 5,000 of his own funds. So for now, we're just going to call it contributed capital. So if you go back to the balance sheet equation, okay, you can see that on the left side, assets goes up, okay. On the right side, stockholders' equity goes up, okay. So the equation stays in balance, okay. 5,000 on the left side and 5,000 on the right side, okay. You can also make the journal entries using the T account, okay. Cash is being debited, okay, and contributed capital, which goes under stockholders' equity, is being credited. Okay. I've used a color coding to make you visualize this easier. Okay. For assets, I'm using this kind of a greenish color. Okay. So for any accounts that fall under liabilities or stockholders' equity, okay, I show them using this kind of orangish, brown color, whatever you want to call it. Okay. Let's go on to transaction B. Okay. On the same day, which is the 1st of January, Joe rents an office space for $650 by paying cash. Okay. So the same day, he's paying $650 cash, okay? Okay, we go back to the framework. We can see that cash has to be credited, okay? We are paying cash of $650, okay? So that account has to be credited. Renting an office space is an expense, right? You're using that space to conduct your business, right? Okay, so that rent should be an expense. Rent expense is a type of expense which decreases your stockholders' equity, okay? What I show here in the bracket, for you as a beginner, it's easier to comprehend what's going on in the overall process, right? Okay, you can visualize that, okay, there is an expense which goes on the right side under stockholders' equity, but stockholders' equity actually goes down because of this expense, okay? So rent expense would be $650, okay, while cash is being credited $650. Okay, you can stop me here and ask me, okay, how did you really know that it's an expense, right? Okay, I would like to set up a couple of guidelines for you to visualize what accounts are going to be debited or credited, right? Okay, every time you see a transaction, first you would ideally have to visualize whether this could be a revenue or an expense, okay? In this case, you're actually spending money into renting an office space, which is an operational expense, right? So this becomes an expense. So the first step is to see whether there is a revenue or an expense as part of this transaction. But if you identified that the transaction is neither a revenue or expense, okay, now you've simplified it. The journal entry can neither be a revenue or expense, okay, so now your choices are limited and it's easier to make the journal entry. The second guideline is much simpler, that you always look at whether a cash transaction has happened, okay. Try to follow if you received or paid cash, okay, and make this as part of your journal entry, okay. If no cash has exchanged hands, it's fine, right? Okay, but make sure that you always look for this at the beginning to keep things simpler. Moving on to transaction C, on the 5th of January, Joe buys 50 football shirts for $70 each by paying cash. He's still paying for everything almost exclusively by cash, right? Okay, 50 shirts for $70, so that's $3,500, okay? He's paying cash of $3,500. So cash has to be credited by $3,500 because it's an asset that is going down. His intention is to sell these 50 shirts later, okay? So that goes under assets as part of the inventory. Okay, so inventory as an asset goes up, okay, and that would be debited by 3,500, and cash, which is an asset that goes down, that would be credited 3,500. Again, inventory is debited 3,500 and cash is credited 3,500. This is an example of a transaction that in a balance sheet equation, both the accounts that are affected belong to the left side of the equation. Okay, inventory and cash are both assets. One goes up and the other goes down, and the equation still stays in balance. Okay, so you don't have to always look for either side of the equation. It can so happen that they belong to the same side of the equation and the equation still stays in balance. Okay, moving on to transaction D. On the 7th of January, Joe borrows $1,500 from a local bank. He's been using up all his cash, so he feels like he needs to borrow some money. Okay, so when he borrows $1,500 from a bank, okay, it creates a liability that he owes this bank. Okay, the most obvious journal entry is that he receives a cash of $1,500. So cash is an asset that would be debited by $1,500. Okay, he owes the bank $1,500. Okay, so that's a liability. We're going to call it note payable. Okay, when you borrow money from a bank, it's in the form of a very formal note, right? You promise to pay back later. So you have to make a journal entry for a note payable. Okay, it's a liability and you're going to credit that account by $1,500. So again, on the balance sheet, you see that the assets go up by $1,500, okay, and the liabilities go up by $1,500. So the equation stays in balance. Looking at the T accounts, cash will be debited $1,500, so it goes on the left, and note payable would be credited, so it goes on the right. Okay, moving on to transaction E. On the 16th of January, Joe fulfills an order from a customer, okay, fixed ports, for 30 shirts at a price of $100 each. Okay, the customer pays $700 in cash and promises to pay what is owed later. Okay, by later he could pay anytime later in the same month or the next month or whatever has been agreed upon. So let's try to break down the numbers. Okay, he sells 30 shirts for $100. Okay, so 30 times 100 is 3,000. Okay, so now going back to the first guideline I gave you, you start thinking of whether there is a revenue or expense involved in this transaction. Okay, you're selling 30 shirts for $100 each to a customer. That can be identified as revenue, right? You make a revenue of $3,000. Okay, but are you collecting cash for the entire $3,000? You're not, right? The customer pays only $700 in cash. Okay, so the remaining $2,300 will be paid later. Or for you as a company, it's a receivable. Okay, so cash would be debited $700 because your asset goes up by $700. You have an accounts receivable for the remaining amount, right, which is $2,300. Okay, that's also an asset which will be converted into cash in the future. On the other side, you have a sales revenue, okay, which increases your stockholders' equity by $3,000. That account would be credited because it's a revenue account. Okay, so putting them in the form of T accounts, cash goes up 700, debited. Accounts receivable goes up by 2,300, hence it's debited. Sales revenue on the other side, which falls under shareholders' equity, is being credited by 3,000. Okay, everything stays in balance. The total of the debits is equal to the total of credits. Okay, but I would like you to think if we are done here. Think about the 30 shirts that have left your premises and have been delivered to the customer. In the previous step, when you bought them, they were part of your inventory. Okay, now out of the 50 shirts, 30 shirts have left your inventory and have been delivered to the customer. And this has to be shown in the form of a journal entry. How do we show that? So your inventory has to be reduced by the value of those 30 shirts. Okay, how do I define value? These shirts were bought for $70 each and were sold for $100 each. Okay, the way your inventory is valued is always at cost, the cost at which you purchased it, right? At $70 per shirt. Okay, so your inventory here would be reduced by the value of 30 shirts multiplied by 70, 2,100. Okay, so your inventory would be credited by $2,100. To specify that you've sold 30 shirts and your inventory value has gone down by that much. Okay, so how do we identify what account has to be debited? When you sell 30 shirts which were valued at $70 in your inventory, okay, that becomes the cost of your goods sold. Cost of goods sold is an expense that goes under stockholders' equity. Okay, an expense decreases the stockholders' equity. Okay, that account would be debited. If you go back to the framework, okay, you can see that an expense account is always debited. Now let's try to visualize the whole transaction together. You have a sales revenue of $3,000. Okay, you also have a cost of goods sold of $2,100. Okay, both of these go under the income statement. Okay, you have a revenue of $3,000 and the next line is the cost of goods sold of $2,100. Okay, the profit you generated in this transaction is $3,000 minus $2,100, which is $900. You sold 30 shirts at $100 each. The cost of each was $70. Okay, so you generated a profit of $30 per shirt for 30 shirts. So the overall profit is 30 times 30, that's $900. Okay. So if you'd like to remember this as another guideline, that's fine too. So anytime you sell something, that particular item leaves the inventory and is reported under cost of goods sold in the income statement. Okay, let's go on to transaction F. On January 25, Fix Sports, the customer who bought from you earlier, he pays cash of $1,100. Okay, he owed you $2,300. So out of that, he's paying you $1,100. Okay. Now things get a lot simpler, right? So you get cash of $1,100. Okay. So cash is debited $1,100. Okay. Out of the $2,300 accounts receivable, you have to deduct that by $1,100. Okay. So accounts receivable is reduced by $1,100. Okay. So you have a receivable of $2,300 and I'm removing $1,100 from that. Okay. So you still have some accounts receivable left. Cash is debited $1,100 and accounts receivable is credited $1,100. The next transaction, transaction G, on the 29th of January, Joe hires a designer to perform a task for $150. Okay, he promises to pay the designer in the following month. Okay, he's going to pay the designer in February. Again, going back to the guidelines I specified earlier, okay, try to think of whether this could be a revenue or an expense, right? You're hiring a designer to perform a task for you. Okay, so obviously it's an expense because they are providing you with a service. Okay, so that expense, let's call it design expense, is going to be debited by $150. Okay, because you're not paying cash, you're promising to pay them later. Okay, you have an accounts payable, which is a liability. Okay, because you owe the designer and you will pay them in the future. Okay, so that account would be credited by $150. Okay. So the design expense, which is an expense, would be debited $150 and accounts payable, which goes under liability, would be credited $150. So once all the journal entries have been done, we can observe them in the general ledger and we can calculate their balances before we create the trial balance. Okay. If you look at the cash account, it was debited in the first transaction, then it was credited, then it was credited again, then it was debited furthermore. Okay. So you can find the balance by adding up all the debits and adding up all the credits, okay, and finding the difference. If the debit balance is higher, you would show the balance on the debit side. Debit accounts like assets typically have a debit balance, right? Okay. So for example, inventory can never have a negative balance, right? It cannot have a credit balance. Okay. So you have an inventory of 3,500, which was debited. And then when you sold goods which were worth 2,100, you're left with goods which are worth 1,400. So you will try to calculate and identify the balances of all these accounts in the general ledger. At this point, I have to state that the trial balance can be created at this step, okay, to ensure that the sum of the debits is equal to the sum of the credits, okay, before making any adjustments, okay. After the adjustments are made at the end of each fiscal period, okay, you update the trial balance so that the adjustments are reflected. And again, you can verify that the sum of the debits is equal to the sum of the credits. The second step, which is making adjustments, will be covered in a lot more detail, okay, in the next session. Okay, in part 3, we will look at them in a lot more detail. But just briefly, why do we make adjustments? Okay, because we want to ensure that the revenues are recorded when they are earned and expenses are also recorded when they are incurred. Okay, so we have to ensure that adjustments are made at the end of each period, okay, to get the revenues and expenses in the right period. Okay, we have the entire third session dedicated just to adjustments. So we're going to look at step 2 in a lot more detail later. Okay. So for now, we're just going to skip this step and assume that this company doesn't have any adjustments to make. And we're going to move on to how to make a trial balance. Okay. So how do we prepare a trial balance? We use the general ledger balances, which I showed earlier. Okay. And we organize them based on the statements they will eventually end up in. You're going to arrange the accounts so that all the balance sheet accounts are together, all the income statement accounts are together. Okay, we'll see how to do that. Okay, and then you show the debit and credit balances of these accounts so you can verify once again if the sum of all the debits and the credits are the same. Let's see how to do this for our example. Okay, so we organize it in a way where we show all the balance sheet accounts first. Okay, cash, accounts receivable, inventory. So these are all the assets which have a debit balance. Okay. Then we have the liabilities which have a credit balance. Okay. Contributed capital, shareholders, it goes under shareholders equity. Okay. Then we have all the revenues and expenses clubbed together. Okay. We know that these accounts go into the income statement. Okay. So we show their credit and debit balances too. Okay. Once we've organized them in this format, we can see that the total sum of the debits is equal to the total sum of the credits. Okay. Where did I get all these numbers from? From my general ledger. The final balances of each of these accounts are being reflected in the trial balance. Once the trial balance has been created, the next step is to create the financial statements. So how do we prepare the financial statements? We match the accounts from the trial balance to the respective financial statements and prepare them in the following order. Okay. First, you prepare the income statement. Okay, so you have the revenue and the expenses information provided in the trial balance. You would use that to prepare the income statement. Okay, why do you do that first? Because using the net income you calculate in the income statement, you can use that information for creating the statement of retained earnings. Okay, once you have the retained earnings balance, you can use that in creating the balance sheet. Okay, let's see how to do that in our example. First, for the income statement, we have a sales revenue of 3,000. Okay, we have our cost of goods sold, which has to be deducted, which is an expense. We have a rent expense and design expense. They're all expenses and they are deducted from the revenue. Okay, and so you have a total profit of $100 for the month of January. Keep in mind that for now, we've ignored any kind of tax implications. So you have a net income of $100 for the month of January. Then we go on to the statement of retained earnings. Okay, because this is a newly set up company, the beginning retained earnings is 0. Okay, the net income of $100 was obtained from the income statement. Okay, and the dividends paid is 0. Okay, there has been no mention of any dividends. Okay, so the ending retained earnings is 0 plus the 100 minus that 0. So you have a ending retained earnings of $100. Okay, that goes into the balance sheet. Okay, looking at the balance sheet, okay, again, we get the balances of all these accounts from the trial balance we saw earlier, right? Okay, so we have the trial balance, we have these balances. So we organize them under the balance sheet. So cash, accounts receivable and inventory go under assets. Okay, accounts payable and notes payable go under liabilities. Okay, under equity, you have contributed capital 5,000. And retained earnings of the 100 we just calculated in the statement of retained earnings. Okay, so together shareholders equity is calculated as 5,100 and liabilities and equity together add up to the same as your total assets. Okay, so in the balance sheet you have to see that the total assets is always equal to the sum of the liabilities and shareholders equity. If you are a beginner, this is something you can always struggle with, right? Balancing the total of assets with the total of liabilities and shareholders equity, and then trying to go back and debug where you might have made a mistake, right? What I would like to show you now is the balance sheet after each transaction so that you can really try to visualize that it's being balanced at each step, right? This can help you in the debugging process whenever you run into a balance sheet that is not balanced, right? Okay, so for example, let's see after transaction A, okay, where Joe invested 5,000 of his own funds, you can see that at the end of transaction A, the balance sheet is balanced, right? So there's 5,000 under assets and 5,000 under equity. Okay. After transaction B, okay, cash went down by 650 and there was an expense of $650. Okay. Remember I told you revenue minus expenses leads to net income. After deducting any dividends paid, what is left is the profit that is retained by the firm. Okay. Hence retained earnings right now is negative 650 because you only have an expense. You don't have any revenue yet. Okay. I'm just trying to show you in a simplified format what the balance sheet looks like at the end of transaction B. Okay. If my month had ended at the end of transaction B, my balance sheet at the end of the month would have been exactly what you're seeing on the screen right now. Let's see what it looks like at the end of transaction C. Okay, you're buying 50 shirts for $70 each. Okay, so your cash went down even further, your inventory went up. Okay, no change on the other side. Okay, and hence it stays in balance. Okay, after transaction D, your liabilities go up, your cash went up by 1,500. Again, it stays in balance. Transaction E, you're selling shirts, 30 shirts for $100 each. So now you can see you're already making some revenue, right? So you're adding a revenue of $3,000 and you're subtracting the cost of goods sold. You can already see your retained earnings is starting to be positive, right? Your cash went up, also your accounts receivable went up and your inventory went down, okay? You can pause the video at any time and do the math yourself to see if everything matches what you see, okay? After transaction F, you can see that cash went up and receivables went down, okay? And the final transaction, so now you would see that the balance sheet matches what we saw earlier, right? Okay. So as you do more and more transactions, you're able to visualize this change happening in the balance sheet. That's why it's important as a beginner that you always see how this affects the balance sheet equation, right? How every single transaction affects the balance sheet equation, and at the end, it still stays in balance. Next, we'll look at how to create the statement of cash flows, okay? We'll look at it in a lot more detail in the 11th session of this financial accounting course. But for now, let's see how to calculate the cash flow from operating activities. Okay, everything was operations except probably how much cash was contributed by the owner and how much cash was borrowed from the creditors, right, from the bank. Okay, except for that, all the other cash flows should be from operating activities. Okay. No investments were made, so cash flow from investing activities is zero. Cash flow from financing activities, okay, that's the 5,000 plus the 1,500 that had been borrowed. Okay, so change in cash is overall 4,150 because it's a newly set up business. Cash at the beginning was zero, and cash at the ending of the period is $4,150. You can try to do the cash flow from operating activities yourself to see if you get a negative $2,350. Okay. The final step in the whole accounting cycle is the closing process. Why do we need a closing process if we've already created the financial statements? We just created the income statement for the month of January, right? Using our example, we just created all these statements for the month of January. Okay. When we move on to creating the income statement for the month of February, we want the revenues and expenses accounts to be reset to zero because what we sold in January should not be reflected in the income statement for February, right? So at the end of January, we have to reset all the income statement accounts, or we can call them temporary accounts. We have to reset them to zero so that they can be ready for the next month, okay? But balance sheet accounts should not be reset, right? The cash balance should not be reset to zero. Okay, the cash balance is carried forward from one period to the other. Okay, these are permanent accounts. Okay, so you don't have to do any changes for balance sheet accounts. Let's get back to our example and see what we'll have to do during the closing process. Okay, first we are going to close all the revenue accounts, okay, into another temporary account. We're going to call it income summary. Okay, so sales revenue, we had a revenue of $3,000 during the month of January. Okay. Remember, revenue is a credit account. Okay. By debiting the revenue account, I'm reversing the revenue that was earned in January. Okay. Or in other words, I'm removing the revenue account and I'm resetting it to zero. Okay. So I would credit the income summary account to store my revenue of $3,000 in that particular account. Okay. So income summary is being credited and sales revenue is being debited. Okay. Next, I would close all my expense accounts and transfer it into income summary again. Okay. Expense accounts are typically debited, right? Okay. But when I'm reversing them or resetting them to zero, I'm going to credit all these expense accounts. Okay. And I'm going to make them to zero and I'm going to transfer them into the income summary account. Okay. Now I'm debiting the income summary account. Okay. All the expense accounts would be closed and they would be transferred to the income summary account. Okay. Once that process is done, okay, the income summary account, okay, you see that it was credited 3,000 in the first step and was debited 2,900 in the second step. Okay. So it has a credit balance of 100. That credit balance of 100 is reversed by debiting. Okay. By debiting the income summary account by $100, I'm also closing the income summary account. Okay. And I'm transferring the 100 to the retained earnings account by crediting that by $100. But retained earnings account is a permanent account. Okay. This stays under shareholders' equity in the balance sheet. So we closed all the revenue accounts, all the expense accounts and transferred them into the income summary account. Okay. Then retained earnings absorbed all this. Okay. And all the other temporary accounts have been closed. And retained earnings is an account which can absorb all the profits that are generated in the future periods too, right? So here we transferred the $100 profit into retained earnings for the month of January. And then whatever profits are generated in the month of February will also be absorbed into the retained earnings account. And now we can see the trial balance which has been updated after closing, right? We can see that all these temporary accounts are closed, okay, and they are being transferred to the retained earnings account, which shows a balance of $100. Okay. With this, we conclude this session on the accounting cycle. In the next session, we'll look at making adjustments in a lot more detail. Thank you for watching. Cheers.